Welcome to This Explainer. Grab your financial analyst hats because today we're doing a deep dive, a rigorous financial autopsy, if you will, on a real-world case study. We hear stories all the time about people striking it rich, but what actually happens when that dream turns into a total fiscal nightmare? Well, we're going to look strictly at the numbers, the structural decisions, and the exact missteps that caused a massive fortune to just completely evaporate. Let's start with the windfall, $1.2 million. Just think about that for a second. For most of us, that's the ultimate financial dream, right? Imagine waking up one morning, checking your account, and boom, a seven-figure balance sitting right there from selling your business. In the finance world, we call this a massive liquidity event. Handled correctly, this kind of capital injection absolutely sets you up for generational wealth and lifetime security. But, and this is a massive but, here's the stark mathematical reality we're dissecting today. From over $1.2 million down to literally zero. Every single dollar, just gone, wiped out in a few short years. It's the shocking true story of an entrepreneur who went from self-made millionaire to completely broke. And from an analytical perspective, the crazy part is that the reasons for this collapse were entirely predictable and absolutely preventable. All right, so here's our game plan for this autopsy. We're going to look at the initial $1.2 million case study, then break down the three fatal errors: the unchecked burn rate, stagnant capital, and speculative panic. Finally, we'll wrap up with the wealth preservation formula. Section 1, the $1.2 million case study, from grind to windfall. So, this is your classic entrepreneurial trajectory. Back in the early 2000s, our subject starts up a small online business. Friends and family were doubting him, but he put in years of incredible, grueling grind. We're talking long nights, literally zero vacations, working straight through every weekend. And you know what? It paid off. Year after year, the business grew until a large company swooped in with an acquisition offer for over $1.2 million. Overnight, the life-changing money hits. He buys a beautiful house, a luxury car, starts traveling the world. On paper, everything looked absolutely perfect. That brings us to section 2, error number 1, the unchecked burn rate, which triggered a massive cash flow crisis. Look at this. The math here just flat out didn't add up. As a financial analyst, the very first thing you look at is cash flow. Your inflows versus your outflows, right? Well, on the income side, zero. The business was sold, so the main revenue engine was totally shut off. But on the expense side, skyrocketing. We've got massive spending on a luxury car, designer clothes, throwing these lavish private parties. Unless those luxury watches were somehow paying dividends, which, spoiler alert, they weren't, he was in huge trouble. Instead of protecting his principal wealth, he spent money like the well was never going to run dry. His expenses went completely exponential, while his income flatlined at absolute zero. Moving right along to section 3, error number 2, stagnant capital. We call this the silent depletion. Okay, so what exactly is stagnant capital? Simply put, it's money just sitting in a bank account, completely undeployed. It's not creating new money. And guys, this is a massive, massive failure in capital allocation. Our subject had over $1 million just sitting idle. So while he's burning through thousands of dollars every single month to fund this crazy lifestyle, that money in the bank is doing absolutely nothing to replenish the drain. Wealth doesn't just sit still, If your money isn't actively working to replace what you're spending, it is slowly but surely disappearing. This really highlights the critical asset allocation error. He held this huge chunk of liquid capital, which was basically idle cash getting aggressively spent, and allocated exactly zero to income-generating assets. No dividend-paying stocks, no real estate bringing in rent, no interest-yielding bonds, just this giant pile of liquid cash bleeding out with zero returns coming back in. From an analytical standpoint, this right here, it's literally a mathematical countdown to bankruptcy. Which leads us to section 4, error number 3, speculative panic, and the fatal chain reaction that followed. As the wealth started vanishing, the desperation really set in. Trying to get even richer, or maybe just scrambling to replace the money he'd recklessly burned through, our subject took his remaining capital and threw it into highly risky projects. The source text points out a major red flag we see all the time in finance: friends promising huge returns and supposed experts guaranteeing success. Let me be absolutely clear. In the financial world, there is no such thing as a guaranteed high return without a correspondingly high risk. None. He essentially abandoned all sensible risk management protocols. Let's track this rapid-fire chain reaction because it happens incredibly fast. Month 1, the market crashes. Turns out those supposedly safe investments weren't safe at all. Month 2, the investments fail completely, and hundreds of thousands of dollars just vanish practically overnight. By month 3, total panic sets in. Instead of just cutting his losses and preserving whatever capital he had left, he tries to recover by taking on even bigger, much more volatile risks. And then, by month 4, the inevitable happens. He's completely drowning in debt. The luxury car has to be sold off. The house is gone. The former millionaire is forced to start over from absolute zero. Finally, let's get into Section 5, the wealth preservation formula, or as I like to call it, getting rich versus staying rich. So the absolutely crucial takeaway here is recognizing the stark difference between the skills it takes to make money and the discipline it takes to keep it. Getting rich, that takes building a business, grinding through the tough times, and eventually selling an asset. But staying rich requires a totally different skill set. It demands smart, analytical decisions. It means living below your means to manage that cash flow and investing carefully to prioritize capital preservation. Honestly, so many people focus 100% on acquiring wealth, but very, very few ever master the skill of actually keeping it. Our source material breaks real wealth down into these 3 core pillars. Step 1, invest carefully. Stay far away from speculative panic and those guaranteed get-rich-quick schemes. Step 2, live below your means. You have to control your burn rate so your expenses never, ever outpace your passive income. And step 3, make your money work for you. Turn that stagnant capital into income-generating assets. Remember, lasting wealth is not built by flashing luxury watches or driving expensive cars. It's built through the strict, disciplined application of these 3 steps. Which leaves us with one final, absolutely vital question to reflect on. Are you managing your money, or is your money managing you? As we've seen in today's explainer, the difference between a millionaire and someone completely broke isn't always about how much money they make during a windfall. It is almost entirely about how they manage that money once they actually have it. So keep these analytical lessons in mind, apply the wealth preservation formula, and make sure your own financial foundation is built to last.